Billionaire investor Ray Dalio is closely watching the risky U.S. fiscal situation. How fast it transpires, I think, is going to be a function of that supply-demand issue, so I'm watching that very closely. Ray Dalio is worried about America's borrowing binge and economic growth cooling. So, what's to learn from his gospels? Let's analyze. We're going to have a debt crisis in this country. The founder of hedge fund Bridgewater Associates said in a media interview with CNBC's Sarah Eisen. He rang the alarm on the ballooning federal debt and warned the U.S. economy is set to slump. The two were speaking at a fireside chat at the Managed Funds Association. U.S. debt levels have ballooned in recent years, especially after a roughly 50% increase in federal spending between fiscal 2019 and fiscal 2021, according to the U.S. Department of the Treasury. Investors fear interest rates may keep rising as the U.S. fiscal situation worsens, hurting the demand for treasuries. The billionaire investor warned of a debt crisis and a meaningful slowing of the economy. U.S. debt levels surpassed $33 trillion for the first time this month, as lawmakers negotiate a U.S. spending bill before the October 1st deadline. A failure to reach an agreement could mean a government shutdown and raise the perceived risk of the country's debt. Dalio is concerned there are more headwinds for the economy than just high debt levels, saying growth could fall to zero, give or take 1 or 2%. I think they're going to get a meaningful slowing of the economy, Dalio said, pointing to an imbalance between the massive scale of public borrowing and insufficient demand for government bonds. Dalio, an official mentor to Bridgewater's 3 co-chief investors, cautioned the mountain of federal debt and other challenges could mean U.S. growth dwindles to zero. The veteran investor had previously flagged America's financial challenges, a historic debt pile, higher interest rates, and quantitative tightening, as well as political infighting and fraught relations with Russia and China, as a perfect storm for the country. Dalio has also noted that high debt levels could spark a balance sheet recession, where growth cools because people and companies focus on paying off loans instead of spending and investing. Several experts have issued even bleaker outlooks, where they predicted stocks and house prices will tumble and a full-blown recession will occur. Their fears have mounted since inflation hit 40-year highs last year, spurring the Federal Reserve to hike interest rates from almost 0 to over 5% in the past 18 months. Higher rates encourage saving over spending and raise borrowing costs, which can relieve upward pressure on prices. But they can also slash the appeal of risky assets like stocks by raising bond yields, pull down house prices by lifting mortgage rates, hammer debt-reliant sectors like commercial real estate, and even trigger recessions by crushing overall demand. Dalio urged lawmakers to address the crisis with utmost urgency. This dire prediction comes at a time when the nation's debt levels have skyrocketed. As lawmakers grappled with negotiations over a crucial U.S. spending bill, the impending October 1st deadline has heightened the stakes, even as the House passed a continuing resolution bill to keep the U.S. government open for 45 days. The Senate passed a last-minute spending bill on Saturday night, voting 335 to 91 to pass the stopgap spending measure, averting a government shutdown that would have triggered a calamitous domino effect on the American public and economy. The Senate voted to pass the continuing resolution 3 hours before, after which the shutdown of the federal government would have taken effect. The bill is now headed for the desk of U.S. President Joe Biden. If signed into law by Biden, the bill would allow the government to stay open for 45 days, giving the House and Senate more time to conclude the funding legislation. The 71-page short-term bill, crafted by House Speaker Kevin McCarthy, R. California, allocates disaster relief funds but does not include new financial assistance for Ukraine's ongoing war with Russia. Since the inception of the Russian invasion of Ukraine, the U.S. has unleashed a war chest worth more than $43 billion in security assistance for Kyiv. Failure to reach an agreement not only threatens to shut down the government, but also amplifies the perceived risks surrounding the country's debt. The House will now resume in the coming week. Given the circumstances, the surge in U.S. debt has been nothing short of dramatic, according to Dalio. Recent years have witnessed a ballooning of debt, especially in the wake of a staggering 50% increase in federal spending between 2019 and 2021, as confirmed by data from the U.S. Department of the Treasury. It's this exponential rise in debt that has set off alarm bells among investors. Investors are understandably fearful that the worsening U.S. fiscal situation may lead to a continued increase in interest rates. Such an outcome could prove detrimental, diminishing the demand for U.S. Treasury bonds and worsening the economic turmoil. While the colossal debt levels are concerning, Dalio's apprehensions extend beyond mere numbers. He envisions a scenario where the debt crisis could potentially push economic growth dangerously close to zero, fluctuating within the narrow range of 1 to 2%. Dalio's words carry substantial weight in the financial world, and his track record as a successful investor bolsters the credibility of his warnings. For much of this year, the Fed has held steadfast to its goal of a soft landing for inflation, the idea of vanquishing inflation without a dramatic economic downturn. But despite several interest rate hikes, inflation is still running hot, and business leaders are saying that it's not a matter of if a recession will happen, but when. In recent weeks, after another rate hike and a promise from Fed Chairman Jerome Powell to stay the course until inflation comes down, Bridgewater founder Ray Dalio said that the Federal Reserve will probably keep tightening its monetary policy until high prices come down, no matter the consequences. As a result, a recession is likely within the next year. You're starting to see all the classic early signs, he said during an interview with MarketWatch editor-in-chief Mark DeCambry. Those signs, he said, are contraction in the housing and auto sectors, which are the first to be impacted by the Fed's higher interest rates. It's not the first time Dalio has sounded the alarm on imminent economic trouble. In June, he was already arguing on LinkedIn that a soft landing was out of the Fed's reach, even as Bridgewater beat the bear market in the first half of this year, delivering a 32% return to investors as other firms struggled. Dalio's comments followed the Fed's decision this week to institute its third consecutive 75 basis point rate hike this year. Prior to June, the last time the bank had made such a big rate hike was in 1994. Those hikes have already slowed down economic growth significantly in the U.S., according to Dalio. We are right now very close to a 0% growth year, he said. I think it's going to get worse in 2023 and then 2024, which has implications for elections. After the Fed's rate hike last month, the S&P fell 1.7% to a 2-month low. Dalio joined other billionaire investors like Carl Icahn and said that the stock market will sink further this year as the Fed continues its hikes, adding that the bond market will be hit particularly hard. Who is going to buy those bonds? Dalio asked, noting that there's been a multi-decade bull market in bonds marked by elevated prices. Now you have negative real returns in the bonds, and you got them going down. Last month, Federal Reserve Chair Jerome Powell said that the central bank will stop at nothing until inflation is under control, even if it means some pain to households and businesses. This week, he was even more clear about the cost. We have got to get inflation behind us. I wish there was a painless way to do that. There isn't. That pain, said Dalio, will be very sorely felt over the next few years. The Fed always has a trade-off, he said, between economic strength and inflation. With inflation now the bank's target, it will chart a course until economic pain is deemed more severe than inflation. This looming financial crisis driven by escalating debt and relentless money printing is a sobering reality. We must take proactive steps to address this unprecedented challenge before it spirals out of control. At that point, the bank will begin to pare back on its rate hikes. Now we play the game of what level will that be, said Dalio. Our economy is struggling with uncertainties, housing issues, foreclosures, global fluctuations, and the pandemic aftermath causing instability, rising inflation, sluggish growth, and trade disruptions. We need urgent attention from all sectors to restore stability and stimulate growth, commented financial analysts following Dalio's remarks. So, what do you think about Dalio's stark warning? Are we experiencing the most challenging phase of our life? Comment your opinion. Do like and subscribe for more. Until next time, bye.